What's up, everyone? It's Karthik with MoneyVest. We are now officially under 2 days till the next Fed meeting. So Wednesday, September 18th, get ready because Jerome Powell is going to take the stage. The world is going to be watching in less than 2 days. We're going to find out exactly how many rate cuts the Federal Reserve is going to do. So this is Jerome Powell getting ready for the super cuts, jumbo cuts now the markets are pricing in. 50 basis points is now fully baked into this market. Some senators, Elizabeth Warren and a few other senators from Colorado and Rhode Island, even wrote a letter to the Federal Reserve Chairman Jerome Powell urging the Fed to cut interest rates by not 50, but 75 basis points. So maybe 50 is not even enough from Jerome Powell, which we'll break down later in the video. But the Dow Jones hitting a new all-time high, well over 41,393. We got the S&P 500 well over 5,600, so a nice little 0.5% gain. And the NASDAQ pushing up over 0.5%. Actually, the NASDAQ going down 0.5%. So a little bit of rotation out of technology over to other parts of the market. And we have a brand new feature on the MoneyVest website, which I think is very, very cool. So overall, S&P 500 today, $50.7 trillion is the market cap for all the 500 plus companies, $92 billion gain. And this right here are the indexes that we have designed specifically for you. So you can take a look, big three over here. We've got Apple, Microsoft, Nvidia. Over 18% of the weight in the S&P 500, just under $9.5 trillion in market cap collectively, dropping over $146 billion. A lot of that coming off of Apple here, down over 2.7%. Then we've got Magnificent 7, so all the 7 companies here, Max 7 here, down over 143 billion. Once again, coming a lot of that from Apple here. And top 10, when you include for Eli Lilly, Broadcom, and Berkshire Hathaway, $18 trillion market cap combined over 35% in the weight, down over $150 billion. So what we have also allowed you to do here now is that you can actually create your own indices. You can create your own sectors, your own stocks, whatever it is that you want to analyze. We give you the market cap change, we give you the percentage weight and the concentration of that particular stock or sector in the S&P 500. So if you want to take a look at banking, for example, so let's come over here and let's take a look at the bank stocks. We got 13 of them in the S&P 500. You've got JP Morgan, Bank of America, Wells Fargo, all these different companies. Combined market cap $1.55 trillion, 3% weight in the S&P 500, and that's where a lot of the liquidity went. We had over 1.5% positive change in the bank stocks, over $23 billion. You can also include for financial services. So over here, you can also add sectors. Now we've got 49 stocks, over 11% weight between banking and financial services, over $5.7 trillion in market cap and $73 billion of market cap inflows into these companies, which includes, again, your Visas and your PayPals and American Express and MasterCard and Bank of America, all those different banks and financial services companies. If you want to take a look at utilities was also a big leader on the day. So we can come over here, 31 stocks, $9.4 billion inflows, 79 basis point increase, $1.2 trillion market cap, and 2.3% weightage in the S&P 500. So I think it's a very, very cool essentially feature that you can now play around with and take a look at a lot of individual stocks. You can build your own as well. If you want to take a look at, let's say, cybersecurity, you can pretty much select CrowdStrike, select this, and it's now going to include that at the top. Let's say you want to include for Palo Alto Network, you can include that over here. So now I've got two stocks, 0.37% weightage, market cap 189 billion, combining those two stocks here, and they were collectively up 1% or just under $2 billion. You can do that on your own. But the bottom line is we did see outflows in technology, Magnificent 7, top 10, big 3 here, and a lot of that liquidity went towards utilities, staples, defensive parts of the market, and more specifically financials and banks as well, which really just clawed their way back with a very nice technical momentum coming in for those stocks as well. So if you come over to the most amount of market cap lost here from Apple, followed by Nvidia, which was also down almost 2%, Broadcom 17 billion, Amazon 15 billion, Tesla, Adobe, Micron, and the companies that actually gained a lot of market cap, Oracle, once again, hitting a new all-time high, right? You can also see that on the market snapshot. If you come over to this particular chart, you'll notice if you come down, Oracle once again, pretty much trading near all-time highs. So $173, $174. That's pretty much the all-time high for Oracle. And some of the indexes that are trading at all-time highs, we got the Dow Jones, S&P 500 utilities, and we got consumer staples. So again, this is a very, very defensive part of the market where money is rotating into. And then finally, we got Meta Platforms gaining a nice 1.7%. We had JP Morgan, Berkshire Hathaway, Procter & Gamble, once again, leading a little bit. Google recovering just over $7.7 billion in market cap, or just under 40 basis points. And we had ExxonMobil and Visa also pushing higher on the day. So we got lots to break down in this video. Make sure that you drop a like and subscribe to the channel. And also, if you want to connect with our MoneyVest community and follow our options portfolio, I've been keeping everybody updated with where we are. I sold more puts on the day today, leading into this Jerome Powell meeting. So this right here is the current options portfolio. Again, you can track this on a regular basis. This right here are regular updates that I'm sending out to everybody in on Patreon and on Discord as well. I sent out every single little detail. You can pretty much keep track, and now we are in week 4 of this portfolio on Patreon. So if you want to keep track and learn how to sell options, learn how to run the wheel and generate some nice income, link's going to be down below. We've got a 16% annual discount that's available until the end of this month. Now, coming over to the Fed meeting expectations. They have now swung wildly since the last FOMC meeting, and 50 basis points is now pretty much baked into this market expectations here. So 67% probability that we're going to see a 50 basis point rate cut on September 18. So Wednesday, again, less than 2 days left. And this number has shifted dramatically in the last, I should say, month and leading up to the last couple days here. You can see the significant shift that we have witnessed. And this number has essentially gone from like less than, 30%, closer to 25% for a probability of a 50 basis point to now well over 60%. And of course, the probability for 25 basis points has gone down significantly from, well over 70% now down to under 40%. So again, markets have really shifted away from 25 over to a 50. And this right here was a letter to the Honorable Jerome Powell from the United States Senate, including signatures from Elizabeth Warren and a few other, like Sheldon Whitehouse from, I believe, Rhode Island, and then John Hickenlooper from Colorado, if I'm not mistaken. So these are the Senate's signing and urging the Federal Reserve to cut interest rates by 75 basis points. So that's what they really highlighted in this letter. We write today to urge the Federal Reserve to cut federal funds rate, currently at 2-decade high of 5.3%, by 75 basis points at the FOMC meeting on September 17 and 18, 2024. So I guess even 50 is not enough. It's getting quite wild in my opinion, because this could really be sending the markets a very wrong message, as we'll go over in the video, because a lot of the speakers on CNBC even today, they were kind of advocating for a 50 basis points. Very few people kind of mentioned that 50 may not be the best idea, and reasons being because the Federal Reserve, there's nothing really that warrants a 50 basis point cut. Yes, we got a tighter economy. Yes, we've got an economy that is at a stage or at a point where interest rates are high, or they've been kept higher for longer, but nothing really has been suggesting that the economy can't handle that, right? So unemployment, of course, is accelerating a little bit slowly and steadily, and we've seen more and more people unemployed over the last year or so, but it's still way, way below what would warrant a quantitative easing standpoint. I think this is just a move, or this is just the beginning or a huge pivot point to begin the process of quantitative easing. This is not the beginning of a panic or a cutting cycle, which is to say that interest rates need to be dropped by 50, 75 basis points because something is lurking in the background, or something that's going to blindside the economy like in the next few weeks, right? So if that were the case, we would already be in a situation where the Federal Reserve would be holding emergency meetings and cutting interest rates really aggressively, but we're not there yet. I think this is just the beginning of a process of that pivot and going from a very restrictive monetary policy standpoint to a somewhat accommodative policy standpoint. So let me know in the comment section down below, how do you feel about this Federal Reserve meeting? Because the entire world is going to be watching, and it's not just Jerome Powell and the Federal Reserve that's going to be taking the stage. We've also got the central banks over in Norway, South Africa, Brazil, the UK, and Japan that are going to be taking the stage on Thursdays and Fridays to go over their interest rate policy as well. So the Dow closed at record high as expectations grow for a jumbo Federal Reserve cut. So we do have Japan later this week. So on Friday, I broke this down in my previous video. I'll talk about that briefly today as well. Thailand also hiking interest rates by about by about 2.4%, 2.5% is where we are today. And then we got Denmark cutting interest rates. We got Eurozone cutting interest rates by 25 basis points. We learned that from the ECB. Canada also cutting interest rates by about 25 basis points in September. And then we've got UK, US, and Brazil later this week as well. So Bank of England in the UK to pause rate cuts, focus shifting to more bond sales. They're going to keep rates where they are. I think they did already cut interest rates in their previous meeting. And Bank of Japan, which is I think going to be the more important central bank because of the carry trade and the trade-off between the US dollar and the Japanese yen. The Japanese yen has been appreciating against the US dollar quite a lot over the last couple months here. And again, the expectations are for rates to stay steady. This is a very similar Fed funds futures for the central bank over in Japan. So we've got a 99% probability that rates are going to stay steady where they are. However, there are expectations for the central bank over in Japan to raise interest rates by 10 basis points, 53% probability that they're going to raise interest rates in December of 2024. So later this year, there are expectations that they are going to raise rates by the year end. Now, South Africa's Reserve Bank is expected to cut interest rates on Thursday. And Norge Bank, or Norwegian global bank here, is poised to hold its meeting on Thursday as well. And the Norwegian central bank kept its interest rates unchanged at a 16-year high at 4.5% in the mid-August, and said at the time that the policy rate will likely be kept at that level for some time ahead. So we're looking at a unchanged policy pivot from Norway, from the UK, South Africa, most expectedly likely going to cut. The Bank of Japan going to stay steady as well. And then we've got Norway, Japan, UK expected to stay where they are. Then we got Eurozone already cutting interest rates. Canada already cutting interest rates. And then now, we got the US that is going to be cutting interest rates. We just don't know by how much. And South Africa also going to be cutting interest rates on Thursday. Now, the Global Liquidity Index, as we have already demonstrated in our previous video, is very much already on its way back higher. It's expected to increase going into 2025 all the way over the next couple of years as inflation is cooling off globally and central banks can kind of ease and take some foot off the gas here with their respective economies and start to kind of ease monetary policy a little bit further to lower interest rates, keep them where they are, or get started on this aggressive cutting cycle where it's going to drive more liquidity back into the market, back into productivity. And this is usually the time when the markets tend to do a lot better if and only if, there's the big if that everybody is going to be questioning. That's pretty much the entire debate discussion. If there is no recession. If there is a recession, we already know the markets can absolutely get sunk to a much lower level. So the Federal Reserve interest rate cuts could boost stocks or sink them, because it all comes down to recession. It all comes down to recession, boils down to whether we're going to see a recession or not. And again, 50 basis points is really going to be, in my opinion, could be sending a wrong message to the market, because it could also, short term, it could be good. I'm not saying that short term the markets can't rally. I think it can be a bit of a positive catalyst for the markets to move higher, but the Federal Reserve, in my opinion, would only do 50 if they actually know something that the markets don't, or if they are seeing something, they're seeing some weakness, they're seeing some significant contraction in the economy, they're seeing some signals that would warrant such a bigger cut. Because another really interesting point that was made in on CNBC that I was watching earlier is that why wasn't there so much cheer for the Federal Reserve to raise interest rates by 50 basis points when they were getting started on the rate hiking cycle? And, this is what happens, right? So we are going to always be a little bit more careful when we know something painful is coming versus we're going to be more vocal on something when we know something more pleasurable is coming. So in other words, for consumers, for investors, rate cuts is very pleasurable, meaning that rate cuts happening, rates are going down. That's going to benefit stocks, right? That's going to benefit your spending. That's going to benefit your borrowing. Overall, rates are going to come down. It's going to be good for your wallet. So of course, there's going to be a lot of people advocating for 50 or 75 or 100 basis points because we like that. We want to see that. But on the way up, there was nobody, at least not in the beginning, expecting the Fed to raise interest rates by 50 or 75 basis points, even though we were clearly behind the curve, right? Because Jerome Powell was constantly talking about how inflation is transitory, it's going to come back down, and we were well over 9%, and the Federal Reserve hadn't even started raising interest rates, and when they finally did, we started by 25, and that's why they had to play a lot of catch-up by doing 75, 75, 75 in order to get ahead of the curve once again and to bring inflation down. And so nobody was advocating for 50 or 75 back then when we were on the way up, but now there's a lot of people advocating for 50 or 75 when we're on the way down, right? So that happens because, like I said, Federal Reserve, when they're cutting rates, that is more pleasurable for people, for stocks, for investors, for consumers, everybody. It's a good time, right? Because quantitative easing in general is a good time. It's good for your wallet. But on the way up, nobody's ready to accept that pain that is going to come with higher and more heavier rate cuts. So, bottom line is recession is what's going to drive this market moving forward. Because as you'll notice that S&P 500's performance around the start of Fed cutting cycles, we tend to get a little bit more choppy here around that time. And then eventually, once the dust settles, when the Federal Reserve starts cutting interest rates and when there is a recession, that the economy falls into a recession within 12 months, the markets, of course, tend to go south versus higher if there is no recession and there is if there's soft landing. So this is what's really going to be driving the markets moving forward. It's not the rate cut itself. Sure, 25 or 50. There's going to be a big debate, and I think 50 is pretty much priced into the market right now. But the bigger moving market event is going to be whether the economy has a soft landing or a hard landing. And you can go over to different time frames, but ultimately the main question is going to be whether this cutting cycle will ultimately be a growth scare or a recessionary episode is the major market question. Because if it's a growth scare or if it's a normal soft landing, in both of those instances, we see the markets moving higher versus if there's a recession and the markets can be lower even 1 year or as much as 2 years later if there is a recession. So I've made myself very clear. I think given the trajectory of the economy, given the unemployment rate and the unemployed persons and the JOLTS numbers coming down, the inversion of the yield curve, the manufacturing index contracting below 50, the consumer sentiment, the consumer confidence. Tomorrow we've also got retail sales coming out. I would not be surprised to see a little bit of a mild recession, as I've already mentioned before in my previous updates. Mild recession in the next 3 to 6 months is possible, and that's exactly what I would prefer for everyone to prepare for. Go back to our basics, go back to the liquidity frameworks, figure out where you want to be, how much cash you want to save up for your emergencies. If, God forbid, something were to happen, if you were to lose your job, how much in savings, how many months worth of savings you want to have in liquid cash so you can get by and you have that optionality, you have that flexibility to move forward. And then also how much cash as a percentage of your overall portfolio you want to have for better buying opportunities, investable opportunities, because recessions usually are the best times to be investing in high quality assets at discounted prices and bargains. And if you do see a mild recession, I would hate for people in our community to not be ready. So you could be invested in the markets and also be ready at the same time. And that's really what I prefer to be. Like, I would be 70, 80% invested. I'm still 20% cash right now. And I do not mind staying 20 to 25% cash for better opportunities, right? So that's where I would personally be, and that's what I would prefer for most people to be, because nobody really knows the trajectory of the economy or the markets. And if the markets do give you better opportunities, the last thing you want to be is just all in invested and not able to take advantage of any of those great buying opportunities. So be prepared for a mild recession, in my opinion, is possible. Even if you don't get one, the trajectory for the markets can be very, very solid as we continue to move higher if it's only a growth scare or a non-recessionary environment. But if for whatever reason we fall into this sort of trap here where the Federal Reserve starts getting into a bit of a panic and they start cutting rates too much or too aggressively on the back of a economic contraction, then we'd be ready. Now, I also wanted to point out that the Treasury market has actually been doing the Federal Reserve's work. I mean, they've been doing most of the legwork for the Fed for quite some time, and we saw a little bit of a double dip here in the 10-year treasuries and the shorter end of the curve, so 2 years. As much as the federal funds rate pretty much stayed where it is, we've seen the 10-year and the 2-year kind of fluctuate a little bit further, and more recently we've seen both of them come down, bringing mortgage rates down, bringing auto rates down, credit card rates down. So everything's been coming down. It's been helping the economy overall, even if the Federal Reserve hasn't really started cutting interest rates. So the market's already priced all those rate cuts into a lot of the financial products that are being issued in the form of loans. So the Treasury market has already been doing a lot of the legwork for the Fed already. And again, some of the other time frames, so this is going back as far as 1984, all suggesting for the same exact thing. The S&P 500 outperforms when the Federal Reserve cut rates in a non-recessionary environment. So really the question for the market is going to be whether we get a recession or not. Non-recessionary versus average versus a recessionary market, where after the rate cuts, things can be very, very different. It's pretty much a split at this point. We can be higher or lower. It all comes down to whether we get into a recession or not. And one more thing I wanted to mention is the fast versus slow cutting cycles. And over here, we've got the speed of those rate cuts. And what you'll notice is that every time the Federal Reserve has done a fast cut, now this is not including for whether we got into a recession or not, but this is simply including when the Federal Reserve did a fast cut, meaning a 50 or more than a 25 basis points, 50, it could be 75. Most of the times, 1 year later, we've been higher, but we've been higher a lot less compared to when the Federal Reserve did a slow cut. So 10.5% in 1970. This was a very good year, 32% in 1974. Then we've got 1981, 9.1%. 1989, we're up 13%. And unfortunately, the last 3 times the Federal Reserve did a fast cut, all signaled a very, very bad time for the economy, because we were down 14%, 20%, and then in 2019, we were up 8.9%. So last 3 times, though, it's been actually pretty bad. But we do still have, on an overall basis, 83% probability the Federal Reserve, after the rate cut, the markets are going to be higher by a median of 16.1%. However, if you take a look at the slower cuts here, right? So we're looking at 1971, 1980, 1984, 1995, 1998. Some of these years, you got 26%, you've got 19%, you've got another 21%, you've got 21%, you've got 21%. So you pretty much kind of average it out a little bit over 20%. Versus if you take a look at the fast cutting cycles, it's closer to 9 to 10%. And then if you include for the last 3 years, it's going to be closer to 4 to 5%, right? I'm just kind of doing some mental math here. But, if you include for those 2 negative numbers in 2007 and 2001, as I also mentioned in one of my previous videos, then the fast cutting cycle, 1 year later, the rates being cut faster than 25 basis points, the markets are on average or median only up 4 to 5% versus well over 20% when the Federal Reserve is doing a slow cut. So just something to keep in mind also moving forward. So what will Wednesday's cut tell investors about the economy? The size of the Wednesday's cut could go a long way towards shaping investors' perceptions about the economy, potentially setting the tone for the markets for the rest of the year. That is true because this is a big pivot after a very, very long time. And the Federal Reserve Chairman Jerome Powell also has a potential to gain a legendary status for steering the economy out of a potential hard landing. But at the same time, he was the one who actually put us in there in the first place because of the transitory inflation. But so you can make a case that, okay, it's a great job well done, bringing inflation down without getting us into a recession. So that's great. But at the same time, they were also very late in raising interest rates to begin with. So this right here is what many people expect 2024 to be, or something 2024 or 2025 to be like. That as interest rates come down, this right here is going to be the potential trajectory that inflation takes. I doubt it. I don't think that inflation is going to get this out of crazy again, similar to what we witnessed back in the great inflation of 1970s or 1980s. But you just never know. If you were, I wouldn't be surprised to see a little bit of that uptick in inflation if the Federal Reserve decides to cut interest rates too soon. And actually, you know what? It's actually quite interesting because we didn't even talk about the possibility of what a jumbo cut or a bigger than 25 basis point rate cut could do to inflation. We only really tackled the idea that a bigger rate cut could signal the wrong message to the market, where the Federal Reserve knows something the market doesn't about the economy. But we didn't even discuss what that could do to inflation, because inflation is not close to the Fed's target, right? It's about 2.7, 2.8% right now, or 2.5%. And there is always going to be that possibility that if the Federal Reserve cuts interest rates too much or too fast, then there's always that possibility to bring inflation back up, or really just accelerate inflation back up. And whatever work they've done so far, whatever effort they've put in to bring inflation down, can all go to waste if they let loose on the inflation picture. So I think that's really where the focus is going to be from Jerome Powell. I think he's quoted Paul Volcker multiple times in his speeches. He talked about how he's learned his lessons from Paul Volcker. They really don't want to compromise their job on inflation, and getting inflation down, keeping inflation lower is their main goal. Even if that means, a little bit of softening on the labor market, even if that means a little bit of pain in the economy, but that's their main goal. And I think that's how it should be. I think fighting inflation is a much tougher, more challenging job than it is to fight a recession. A recession can be fixed. Believe it or not, a recession can be fixed. It's more painful though, I would give you that. It's more painful, but it's a lot easier to fix than it is to fix inflation. Inflation, once embedded in the economy, can be longer lasting, and it can really eat away into the savings rate. We're already seeing that, right? Savings rates under 3%, just depleting people's savings. So it's kind of like a hidden tax on people who are not able to afford everyday items. So while recessions may be more painful, people unemployed, people not able to pay for stuff and not able to find a job, they can be fixed a lot easier. In other words, they can, Federal Reserve can cut interest rates faster. They can do them very, very quickly down to 0% and stimulate growth and stimulate the economy versus inflation. It's a slow and steady process, right? So as I've always said before, the risk of cutting too soon is always greater than the risk of cutting too late. So always remember that, because it always carries that risk of reacceleration on inflation. Now, coming over to the MoneyVest dashboard, we are at 3.89, 17 volatility readings. We're in the 47th percentile. And one of the things that I really wanted to address here is the price earnings multiple now on the S&P, back at almost 23. We're in the 90th percentile on the S&P 500 price earnings multiple. 73% stocks, 74% stocks back above their 50, 200 SMA. 70% back above their 20 simple moving average. Put call ratio 0.810 here. And we got the 9% in the contango level as well. We got green across the board. The only sector that is struggling right now is going to be energy. The dollar, of course, has already been selling off quite a bit. So it's across the board below its 5, 9, 21, 50, 100, and 200 SMA. And energy is the only sector that continues to struggle right now. So this right here is the pullback that we're seeing in energy prices on the back of crude oil coming down. Tesla back below its 5 SMA. We got Nvidia also rolling over below its 50. Apple sold off after the sluggish sort of first weekend after the launch reports that we got. So it wasn't really good sell-through rates, at least not from the initial reports that we're seeing. And Google here is still battling the investigation from DOJ, still below its 9, 21, 50, and 100 SMA. But overall, we've got a very, very technically technically strong market here. And iPhone 16 kind of lagging sales according to some of the estimates here on pre-orders. 37 million is what they estimate for iPhone 16 pre-orders, which is down 12.7% on a year-over-year basis. And some of the more categories here, standard 7.3 million, plus 10% year over year. But most of that pain coming from Pro and Pro Max, which was collectively up to as much as 27 million, down 27% and 16% respectively. And we also had Intel pushing higher very, very well. So if you take a look at where Intel is right now, we're up a little bit over 9% right now after hours, after clocking in a deal with the U.S. military of $3.5 billion to supply chips, and also with AWS to expand strategic collaboration on chip manufacturing as well. So we had lots to discuss, lots to unpack here. Now coming over to the market, volatility still trading down to low 17s here, and 15 is going to be that next level to keep in mind. And we've got 18, 20, all the way up to 23. We'll see what the Federal Reserve meeting brings in terms of volatility for the market. If you do see a VIX spike again, we're going to be ready to deploy some capital back into the market and, of course, buy into that pullback. And then coming over to individual stocks. But before we get there, crude oil getting a nice little bounce back over $70 a barrel. And resistance is going to stay put here inside this red rectangle for crude oil, sitting roughly at $71 to as much as $73 per barrel. And then coming over to the MoneyVest index, as we have already discussed. But on Friday, we were just over 3.86. I think that's really where we are right now as well. We didn't really move much here, 3.89. So just a small increase on the day. So we're once again getting closer and closer to 4. I gave you guys a warning last time when we were just over 4. We dipped down below. Once again, we had a nice little pullback on the S&P 500, and now we're starting to move back higher. Very briefly, we spent about just a day at under 3.5, and we're now back closer to 4 once again. Now coming over to the markets, and first things first, S&P 500 here on the 30-minute time frame. We're still kind of below that resistance, which we talked about over the weekend and in our last update as well. And this right here is the technical resistance for S&P 500. So keep in mind, we've got a very, very strong area of supply and resistance at 5640. So that's going to be that level to keep in mind, of course, going into tomorrow as well. And support level is going to stay put right here inside this green rectangle at 5575 to as much as 5570 for S&P 500. QQQs, on the other hand, getting a little bit of that resistance there. At 476, we gapped down, sold off a little bit, pushed right back up. So we're still trading below that area of resistance and supply for the NASDAQ 100. So that's going to be that level to, of course, keep in mind, and support level all the way down to 468, down to 464, and a very, very strong area of demand here, sitting roughly in 448, 449 for QQQs as well. Coming over to Apple, and before we get there, I also do want to break down some more charts here. So XLK divided by XLU, that underperformance continues. On the day, it was down over 1%. So, this is a chart that I've shown you guys before, which is a very clear indication for the market that it is defensive right now. It is not risk on. We are clearly not risk on in the markets right now. And if you simply take a look at the stocks and the sectors that were red on the day, discretionary, technology, and the NASDAQ, all three very much focused on tech, right? You've got your Amazons and Teslas and Apples and Googles in there. And then, of course, you've got financials. So banking, as I showed you earlier in the video, energy, staples, materials, even the bond markets with TLT gaining almost 1% on the day. So a lot of momentum, a lot of flight to quality away from technology, away from risk, over to more defensive parts of the market ahead of the central bank's meeting on Wednesday. So this is how the markets are positioning themselves. They're kind of moving over to safety on the sidelines to see what the Federal Reserve does, to see what the markets kind of takes in on all that data, how does the market react, and then move back into risk assets. And that's really how we're kind of shaping up to be, how we're positioned going into this Wednesday. IWM, for example, also very, very flat. It's expected to be one of the big gainers here after the jumbo cut. We'll find out if that's the case. But usually, bigger rate cuts could be a potential positive catalyst for small caps, mid caps, as they battle through some of the higher interest rate environment. And again, IWM, I'm very bullish on that, optimistic for the near term as well. Okay, so coming over to Apple, and Apple, of course, selling off, a little bit more aggressively here. We're actually right about there. You can't see it, but let me just remove that from here. And there we go. So we're right about there. That's the candle. And it's at support. So we're at 216, 218, in and around those levels. If we continue to sell off, the next target is going to be closer to $207 for Apple moving forward. Talking a little bit about Amazon now. And Amazon here, resistance is going to be all the way up to $189, closer to $190. The support level staying put at $181 per share for Amazon, all the way down to as low as $173 for Amazon as well. Huge resistance, by the way, coming up to 189. Coming over to Tesla, and Tesla here, support level is going to stay put down to 225. Huge resistance up to $233. It's been moving slowly and steadily with a nice higher low here, as you can see. So this right here can be considered as a little bit of a higher low, so that's decent. And some higher highs also coming in for Tesla. So you can make a case that, okay, there's some strength, there's some uptrend for Tesla here, but we still do have a very, very strong area of resistance that Tesla needs to break out of around here. So that's going to be 232 to as much as around 240. If you can break that supply wall, then the next target is going to be in the 270s for Tesla. I got calls all the way up to 300s. So I don't expect Tesla to break out of these levels anytime soon. If it does, great. If it doesn't, then those calls are going to print. And Tesla's volatility definitely gives us very juicy premiums. Coming over to NVIDIA. And NVIDIA is trading right about that higher low here. You know what? That higher low, in my opinion, I think is a little bit more invalid. But this right here is going to be that resistance right now. So we're sitting at 118 as a huge area of supply that we're not able to break out of. High of day was 118, so not able to successfully close above that level. I sold some more puts on the day, and I've got my cover calls expiring this Friday, and I shared all of my trades and all of the different scenarios and how it's going to play out. And support level is going to sit at $96 per share for NVIDIA. Resistance, like I said, 118 all the way up to 139. Coming over to Advanced Micro Devices and AMD also, support level is going to stay put at 142. We are still making lower highs and lower lows right now. So this right here is going to be that lower high, lower low, a little bit of a higher low right now, and support level is going to stay put at 142 for AMD. Coming over to Meta platforms, and Meta here pushing higher very well, 1.6%, resistance all the way up to as much as $541, coming up to that area of supply once again, support level at 479, down to as low as $458 per share. A lot of consolidation sideways for Meta, as we've already discussed. It's pretty much been trading in that area of supply for a really long time. Netflix, on the other hand, once again getting rejected at that resistance here at close to $700. So this right here is that level to keep in mind for Netflix. Support level is sitting roughly at 661 for Netflix. And Google on the day pushing up. So nice little recovery from that area of support at 149, 150. And next target and resistance all the way up to 164 for Google, and a very, very strong area of support here in the 150s, as we have discussed in our previous updates. And Microsoft here also pushing higher, but up to its resistance. So resistance is going to stay put at 432, with a very strong support in roughly at 397, close to $400 per share for Microsoft as well. Coming over to PayPal here, and PayPal on the day, also nice little recovery from that area of support. We talked about it, got rejected at 73.74. It was very normal because of how overbought we were. So coming back down, validating that support, and then pushing right back up. Resistance all the way up to 74. Visa here also with a very, very nice momentum coming in, just straight up. Breaking out of that resistance and pushing up to almost new all-time highs, up over 14%. In fact, it hit a new all-time high today, $290.90. But it's very, very overbought here. RSI and MACD incredibly overextended, so I wouldn't be surprised to see a little bit of a pullback on Visa. $282 is going to be that support level to keep in mind. And last but not least, we got Enphase and Costco. Enphase on the day, up over 1.4%. Again, continues to consolidate sideways in that range. Really been trading between 92 and 142. And then finally, we come over to Costco, which on the day was also a little bit pulling back here, down almost 90 basis points after, of course, seeing new all-time highs last week as well. So resistance all the way up to 919, 920, support level at $872. So hope you all enjoyed this video and a complete update on the markets. We got lots of very, very important catalysts and data points coming up later this week. So make sure you drop a like, subscribe to the channel if you're just joining us for the first time, and join our Discord, join our community on Patreon. I'm sure you'll get a lot of value, a lot of insight in our community. So let me know if you have any questions. 16% annual discount that's available until the end of this month. And as always, happy investing. I'll see you all in the next video.